Hi everyone, welcome to our first commercial masterclass. My name is Jocelyn. I'm the commercial lending director at XIN Mortgage, and I'm honored to be your host today. So this session is brought to you by XIN Mortgage, where we specialize in helping clients navigate through the world of property finance. So today's seminar is packed with insights to help you understand the commercial property market, make informed investment decisions, and plan your financing strategies. And before we dive into our agenda, I love to introduce two incredible people joining me on the panel today. I've got Tom on my left from Alba Property, who is our co-host. He's the founder of Australian leading buyers agents, who work with aggregation of buyers agent Australian-wide to purchase properties across all asset classes. And I got Jackie from Cohen. He's our special guest tonight, who brings unparalleled insights into commercial property investments. Cohen is one of the first and largest dedicated commercial buyers agency in Australia, who is renowned for their market knowledge, particularly in helping clients navigate safe assets with high growth and optimal yield. Jackie has worked with many clients to identify and secure top-tier commercial properties, and he's here to share his expertise. We're honored to have them with us today, so get ready to learn from the best. So here's what we will be covering today.
Awesome, thanks, Jocelyn, and a big welcome to everyone. And I think just as an extension of what Jocelyn said, it's a real privilege to be working alongside high quality, high caliber property experts, and to commit a forum and an environment where we talk all things, asset class, funding, and the market, shows that the group is really committed to ensuring that people who have interest in commercial or equally looking to diversify or growth wealth through property provide all those resources. So whilst you've got a clear agenda that talks to what today is all about, we really want people walking away, feeling exactly what I just described, right? A real commitment to information, insight, and experts available. And again, as Jocelyn's mentioned, really encouraged and enthused about having Jackie along, who's got some really good insights to tell. So we are really committed to actually getting you to that point of showing you some great examples of assets. So we'll get to that point, but we're going to talk you through to some fundamentals of what's happening in the market, as well as the finance area, and we'll go from there. So with that being said, I'm just going to give a very, very brief market update. And we thought visuals tell a really good story. Some of the consistent questions I get asked, and Jack, it'd be really good to hear from you too at some point around this question, which is, what type of commercial asset should I buy? What's giving me the greatest yield? So whilst it's all circumstantial, it depends on the market. We thought we'd just give you a quick visual of the commercial volumes and what type of asset people are buying. But I think from my perspective, and at Alba, we've gone through and we still are within a high interest rate market. We've had 13 rate rises, and whilst we talk about that in the residential space, it's no different in the commercial space. Sales are up from this time last year, and we are starting to see a return of confidence in the market, both for investors and owner-occupiers, people running their businesses out of these asset classes. And it does suggest that the year upcoming will provide some optimism. Okay. There is also a reality around yields. So we often hear about people wanting those 9%, 10% return, 10% yields on great assets. And the reality is some of that is just not necessarily a reality at this moment in time. And we've seen probably the inverse, or the unintended benefit of a high rate environment, whereby rents are naturally increasing in your industrial segment, and therefore seeing some yield growth in the last 24 to 48 months. And I'm sure, no doubt, most commercial buyers agents will talk to you about that being a particular asset class of interest for particular investors. So that's how it's summarized. It's a high interest rate market. Optimism's returning. 2025 will present the right type of opportunities for the right investors. Those yields of your 9 to 10%, whilst they seem attractive, and you'll hear very shortly why it's about the quality of your tenant, the quality of your lease, that gives you a reliable and sustainable yield return. that's where a commercial buyer's agent is really going to help you acquire something fast, safer, and easier. And 2025 presents those opportunities.
Yeah.
Over to you, Jocelyn, and maybe you could share with the group just around the lending market and what's happening in the finance space.
Yeah, so as you can see from this graph, over the years since 2004, we can see that commercial lending is gradually growing, increasing. There's a sharp rise in 2016 because of the boom in property market. Like a lot of developers are getting big loans. That's why there's a sharp rise, and then drop again. However, and just before COVID, it dropped further because not many people are asking about commercial. But during COVID time, where people have additional discretionary cash, they started to get into commercial property market heavily, and then it dropped again just because in 2023 because of the interest rate hike. But we can see that it's going back up again. Like everyone just want to get into the commercial property market. So I'm just gonna go through some basic differences between a commercial and a home loan. So commercial loan normally is for business purpose, for investment, similar to a residential loan, but the properties they're buying normally is for business purpose. Loan term generally for home loan is like your standard 30 years. Commercial depends on the lease term, things like that, but it can go up to 30 years if you use like a residential property. Interest rate normally for home loan it's lower. However, in high interest rate market, for commercial loan the interest rate can be quite similar to a home loan, and also it works differently when it comes to the repayment and the interest rate. If you go for a lower loan term for commercial, you can generally get a cheaper rate. Yeah, so it's a complete opposite of a home loan. And there are just different types of lenders that can do a commercial loan. It's banks, non-banks, private lenders, things like that. Just more options. And this chart I find it very interesting is the key criteria where how does a lender look at a commercial loan. So in the past, the banks not generally look at WALE. WALE is weighted average lease expiry. So they will look at the average of the lease term of the tenants and the vacancy rate. However, in 2024, in a high interest rate environment, the bank started to look at more at leverage. Basically, how much is the bank willing to lend to the client? And also, this is the number one question that we got asked by clients: how much can the bank lend me? Because in the high interest rate, you can't borrow as much as you can when the rate was 2 to 3%. And the second most important question is the asset type. This question has always been one of the most most important questions that asked by a bank, like what type of asset that you're buying, then we can, based on the asset, we lend you certain LVR. Okay. And this chart shows that the difference, so the percentage of the differences between banks and non-bank. So the domestic bank used to own the bigger pie. And then, however, in the high interest rate environment, the non-bank is getting more attraction, because now people are asking more about how much they can borrow, and they want to borrow more than what the traditional bank can do. So that's why the non-banks are getting more favorable, and also for developers, they always want to borrow to the max. Okay, sorry. Yep. Now I'm just going to introduce you to our special guest.
Thank you very much, Tom. Thank you very much, Jocelyn, for the introduction and for the insights. I can see we've got a large crowd of online presence here, as well as got a small crowd that's obviously with us, on the floor. So I would like to say thank you for the invitation, and bear with me. If you have any questions, leave it till the end. What I'll go through with you is how when we are acting as buyer's agents for you, what criteria we look out for, what red flags we look out for when selecting these properties. I'll go for a couple of case studies with you. If you have any questions, like I said, let me know at the end. I will be more than happy to attend to any of your queries. For me, I usually break down, because today's focus is more on long-term investment assets. We usually focus on two things, right? The lease and the property itself. So in terms of lease, the main criteria that we look at, firstly, the yield, right? Obviously, we are buying commercial property for its return. So having a safe and optimal yield, right? That's really important. Secondly, the tenant. Is it a national tenant, international tenant? How long has the existing tenant been here for, right? These are all extremely important when we make these decisions about, is this the right commercial property to purchase, right? Some people like high tenant turnovers. Some people don't. Some people just want to have a set and forget asset. And in fact, from my experience dealing with a lot of BAs and clients, right, they want generational assets with the tenants being there for a long time, right? Having high quality national tenants there, that's probably something that's very attractive to them, right? So we need to assess the quality of tenant, right? As well as, you know, how long they have been staying there and how long they will be staying there. Lease term, what's the initial lease term, right? So initially, how long is the lease going for? Are there any more options that follow afterwards, right? So obviously that displays, right, having more options display the tenant's intention to actually stay on in the property. And then we look at the securities, right? Now, the typical kind of securities that tenants usually provide are either head corporation security, so head corporation guarantee, or personal guarantee, or bank guarantee, right? When we assess a good lease, right, we would like to see either one or two, even better, all three of these securities being in place in the lease, right? And we also would like to look at what's the rent review. So each year, right, by how much is the rent increasing? Typically speaking, a lot of these rents will be increasing by either like 3% or CPI. That's with a lot of these investment properties. However, obviously each lease needs to be scrutinized carefully because they all have different rent review terms. The last thing that different from a residential property, right? Something that we really look at in a commercial property is whether it's a single net lease or double net lease, or sometimes a gross lease or semi-gross lease, right? What do they all mean? That means how much liability the tenant is actually taking on themselves. So your land taxes, your council rates, right? Water servicing bills, all of these fees, right? Who's paying for them? Now, in a residential setting, right? Most of the time, the landlord is actually paying for a lot of these things. But in a double net lease setting, which is what we like to get for our clients at Costicoan, right, is we'll like to get them a double net lease where the tenant needs to pay for all the outgoings, other than probably things that are related to structures of the building. Now, in terms of the property itself, we have a couple more selection criteria. So firstly, the location, right? Is the location in a busy part of the town center? Is this the location that the client is looking for? And secondly, the structure. Is it a concrete structure? Is it a steel structure, timber structure, whatever it is, right? And how long has that structure been established for, right? Are there any DA conditions or OC conditions that might affect the future operation of the property and the tenant when it's operating inside the property, right? And also look at a couple of pricing plans. So a lot of our passive investors obviously look at, the future growth, right? How much or how strongly is the property going to grow into the future? So then we look at, okay, is the government taking initiatives, actions, plans in the local area that would likely boost the population, boost the infrastructure, and hence boost the future value of the property? These are only a couple, like even after discussing all these points, these are probably only a handful of the selection criteria that we really look at in the whole process. Like really, in past experiences, we probably look at 30 to 40 of these criteria, which obviously I'm not going to go through in a lot of detail today, but yeah. Okay. Now I would like to share with you a very good warehouse case study first that we've recently done in Penrith. This is we purchased this for a Chinese foreign investor. Now the vendor was asking initially on this $14.5 million. Now this Chinese investor, we've actually spent quite a long time, about about 2 to 3 months trying to find the right property for him. So it was a case where we found we spent a long time looking for him, but the actual process of closing the deal took around 2 to 3 weeks. It was a quick turnaround deal. Yeah. Now, depending on, and we'll see in the next case study scenario as well, sometimes you just need the deal to go fast, and sometimes you actually need to wait it out so that you can get the best price possible. Now, this property is an industrial property in Paris, west of Sydney, and it's tenanted by a very famous plumbing supplies tenant called Reese. It's a national tenant, very A-grade asset. Now, it's situated on a fairly big block, 4,200 square meters. It's a passive investor as well, so all our investor really want to do, all our client really want to do, is to buy the property and collect rent, right? Now, obviously, the vendor was represented by very qualified sales agents who are desperately trying to protect the vendor's interest, as they should. But what's our job at Costicon? Our job is to fight it out on behalf of our client, right? Try to get our client the best price possible. So now there's a couple of factors and a couple of strategies that we use in order to negotiate this price. As you can see, we've made a substantial amount of saving, but how do we do it, right? It's all about the process. One of the first things that we've done right is that this is an off-market property. Now, in fact, about 80% of the properties that we acquire for our clients are off the market, which means that most of these competitors that you would otherwise have met when looking at on-the-market properties have effectively been eliminated, right? Because they don't even know about the deal. They don't even know that this is for sale, right? So the first thing that we did right was eliminate competition through off-market transaction. Secondly, when we were doing due diligence, we found a couple of issues on the property, which weren't major issues. They were not major issues, but we've magnified them so that they seem like major issues and use that as a leverage to negotiate our deals, right? We can't, like, it's not just a simple case of saying, hey, you know, you're asking for 14.5 mil. Well, you know what? We just want 12 mil. Sell it to us, right? That's not what we do. This is not the art of negotiation, right? You've got to use strategy. So these two strategy were the first and foremost that we used, right, in order to negotiate this deal. Now, we have very good relationship with these sales agents, right? We've done a lot of deals together before, right? And we were also able to leverage that relationship to ask the vendor's agent to work with us and communicate with clients in order to get the deal done. So ultimately, what's the result? We were able to save $1.25 million off the original purchase, off the original asking price, and made a substantial saving of 8.6% for our clients. The next case study that I have, but actually, you know what? Before then, I think this is probably let's go back to that case study. That's probably a good point for Jocelyn to talk about, because I actually want to ask you as well. Our client on that deal, they actually had a kind of a difficult time trying to get a loan. I'm not going to mention which bank it is, but they actually had a difficult time trying to get a loan for this. They were trying to aim for like a 60% LVR, but in the end, the bank was only able to approve 50% because they sort of classified it as like a different asset. Just on this topic, what advice would you give to our audience on the floor and online here regarding, you know, lending tips for warehouses? What lending tips can you give?
Thanks, Jackie. So actually for warehouse properties, the banks love it. Because warehouse properties, there's a low vacancy rate across I think across the whole Australia. So the bank loves this kind of asset because there will always be tenants who are wanting to, you know, just rent a warehouse. And actually there's a shortage of warehouse in, like, everyone just want to buy warehouse now. So the bank loves this kind of properties. And for the bank, generally for warehouses, for own use, you can borrow up to 70 to 80%. And for investment, depends on the lease, like the rental income. We generally we can lend like up to 60 to 70% is is typical. In your case, because it's 50%, it probably means that, the rental income at the time could be low, it hasn't been renewed, things like that. And so then based on the existing rental income, the bank could only lend up to this much. But there's so many solutions out there. If you're not happy with 50% LVR, you can always go to like non-bank who are happy to, lend up to 80% for warehouses.
Actually, sorry, just a follow-up question, if you wouldn't mind, Jocelyn. Because probably the issue that my client has encountered on this, he was trying to go for a bank and he's bank manager, but somehow I think that particular bank wasn't able to cater for his need. Like as a broker, what sort of more like how, I guess, what sort of advantages do you have in comparison to like a banker?
Yeah, so for the bank, as you know, because I used to work at CBA, so for a banker, they can only provide one solution, which is the bank that they work for. But as a broker, we have so many different solutions. But normally we'll ask clients which lender they prefer, because some clients, they prefer to stay with their existing bank, current bank, because they're comfortable with them. And then, so what we do is we normally try Big Four first, because they are the cheapest. And then if client, let's say they want to borrow more, then we try a second tier lenders. And if they still want more, then that's when, if they're happy to pay a higher rate, they just want to get the LVR because it's for investment purpose anyway. Then we go for non-bank, and then our last resort will be a private lender. So we have connection, we have access to all these different type of lending providers. So that's the advantage of using a broker instead of you approaching the bank. Yeah, and we'll make sure that the client's need is met and also get the best deal.
Yeah. Great. I'm sure that answers a lot of questions for our
audience. Yeah. And then maybe just then on that point, both of you, like what's the advice around someone who's making a decision to enter the market and buy, but they haven't got finance yet? So Jackie, from an acquisition point of view, is it your preference that the client is really clear on what they can borrow and why? And then equally, Jocelyn, because as you mentioned, different asset classes have different requirements, and then notwithstanding the way the client's going to fund, is there general advice on what an investor should do first before they actually decide to enter the market and buy? Is it get finance first, speak to your broker, or speak to the buyer's agent, or do both? What do you reckon?
You know what? I actually, when a lot of clients always ask me this, but for commercial property, I always strongly recommend them to use a buyer's agent, because I've seen so many of my clients complain about, oh my gosh, I bought the wrong asset. Their first commercial property is always flop, unfortunately. And they thought that, buying a shop at Chatswood is good, but what if it's not the main street? It's like things like that. I just heard too many times, and I will normally ask them to engage a buyer's agent. But at the same time, if they do have that desire to buy a commercial property, they normally will have, finance. They will have the capacity to purchase. So then I will work out like a borrowing capacity for them to let them know, oh, that's your budget. And then when you come to when you see an asset, just let me know when we can work out the calculation. Yeah.
No, I think from my experience and the experience of a lot of my colleagues, not every single client comes prepared. Now we go through a process, obviously, very carefully selecting our clients, making sure that before they embark on this property purchasing journey with us, that they are financially prepared, they are pre-approved, and I very strongly encourage them to do that, because a lot of times you get presented with good opportunities, but you can't act on them because your finance is not approved. And probably by the time your finance is approved, you may very well have missed out on the opportunity. So I very much encourage that, although not every single case has been that they've got a pre-approval. Look, we help our clients to work with brokers like XIN Mortgage to get pre-approvals like that, to assess their buying power before we go into actually finding these properties, and that's really important. Yeah. Is any more questions? No. Okay. Well, let's. All right. I'm very excited to talk about this one because we made a massive saving for our clients on this one. Now, this is probably one of the cases where you need to stretch out the game a bit longer probably a bit longer than what I've liked to do the deal, but we stretched it out. This deal was done within a turnaround period of 1.5 months, so about 6 weeks time. But what we were able to do was get the vendor's expectation to a more realistic level, and on that basis, then negotiate the price. Right now, the vendor was thinking an asking price of $12 million, which from a yield perspective was okay, but we thought that the amount of we thought that this price that he's asking for isn't what the property itself is worth, right? Something that we look at for our clients is what we call replacement cost, right? That is the cost that you would otherwise have spent if you were to buy a land and build a similar property today. We always buy for our clients properties below replacement cost, right? Because otherwise you'll be paying a lot of money, not for the property, you're paying for the business. And if the business leaves, well, you're really paying the money for nothing, right? And this is where we advise our clients. We said, I don't think we should be buying at that price. It's a great asset. It's got a lot of kids in it. I remember it was about 145 bed, 145 children's spot in it. It's tenanted by an ASX listed childcare operating company, right? So everything about it was very good, but the price, right? So I advise my client, let's wait it out. I think the market will make him realize that, his expectation was unrealistic. My client really liked it. And this was a sort of like a semi off the market property. So people have seen it, but we were able to secure it after a month of like them sort of like off market campaigning this property. We've also been speaking to the vendor in the meanwhile. We made bids that were significantly below what they were asking for. And I guess a lot of the other offers made the vendor realize that $12 million is probably a bit too much. Now, for a similar strategy of identifying the weaknesses in this property that we could leverage to negotiate the prices, as well as leveraging our relationship with the vendor agents on this deal, we're eventually able to save roughly $2.4 million of where they were asking. Now, this is where our advice becomes really important, because you need to realize that the price that the vendor is asking for might be significantly beyond what the market price is, right? And then with a bit more patience, with a bit more strategy, you're able to secure at a better price. Yeah. Okay. And I guess I'd probably propose a similar question to you, Jocelyn. On the topic of childcare centers, do you have any lending tips for our audience?
Yes, for childcare center, it's very interesting. So few years back, childcare center, the banks think that, okay, it's enough. Like, we don't want to lend to childcare centers anymore. So some of the big banks, they even said that no more childcare center. So generally, childcare center is considered like a specialized asset. The bank will lend up to 50%. But recently, we can see that there are more traction in regards to childcare centers. Like Jackie said, that it depends on the tenant. Actually, if it's a good tenant with providing guarantee, then nowadays the banks can lend up to 70%, because childcare rent is generally very, very good, and good tenant, long-term lease. The bank sees that now that they change the appetite, they were willing to lend up to 70% for childcare. But it depends. So if you get like unknown childcare operator, then probably it's still 50%. So it depends on the tenant. But yes, childcare center, it's back in the game again.
Okay, great, awesome. I think to finish up, I guess my part, I just want to tell look, it's probably a very similar process that like from the surface, a lot of buyers agents might follow. But what we do here at Costicon is we focus a lot on the concept of safety of the asset and due diligence, right? You might find that a lot of buyers agents might follow a similar process, but they don't actually understand the technicalities behind conducting these due diligence for these properties, right? Myself included, the whole team at Costicon, all came from a very specialized background in property that is not just sales, right? We understand the construction, the development, as well as the commercial nature of these properties, right? Which is what enables us to do this process a lot better and in a lot more detail than our buyers and peers in this industry. So we start off by understanding actually what you are looking for, right? What is it that's the most important to you, right? What is it that we should focus on? What's your asset type? Where are you looking? How much money are you planning to spend? Your budget. What yield are you looking for, right? Are you a passive investor? Are you an owner-occupier? Are you a developer, right? And then our second process is we then once you sign up with us, we take a brief and we reach out to not just the sales agents. We also speak to leasing agents. We speak to funds. We speak to vendors directly in order to acquire these properties. And in fact, for that particular childcare that I was just talking about, we were able to communicate directly with the vendor as well to get the deal done because we had a pre-existing relationship with them. Now during this process, we would filter out and do some initial due diligence to check this is the right property for you. And unless it's 90% to 100% similar to what you're asking for, we wouldn't really present it to you, right? Only when it is very similar to what you're asking for, we're then putting out and shortlist it, and then we'll conduct a presentation with you. So I'll come to you, present to you on these properties, usually about 3 to 4 properties, and say these are the strengths and weaknesses of each property, and then you can choose, right? Now, if you happen to not be happy with these properties, that's okay. We start the process over again, right? It's not something where it's like I select the best properties for you and you don't accept it, and we're like, okay, you know what, we go our separate ways. That's not what we do, right? We want to make sure that you buy the property that you like, and oftentimes that takes a few rounds, right? And we're more than happy to be patient with that. Now, but if say out of these 3 or 4 properties you like 1 or 2 or 3 of them, then we can proceed with starting to make offers. Now, when making these offers, we'll do further due diligence in the meantime, and then conduct our negotiation on the prices using the strategies that we mentioned before, right? As well as just reviewing these leases in further detail and reviewing the sales contract in further detail. Now, when we've been able to negotiate the prices, the settlement terms, the deposit, these critical terms to a satisfactory extent, then we proceed to work with the building inspector, work with your solicitor in order to review the contract and look at the property, right? To make sure that you're safeguarded against any structural risk, property-related risk, as well as any legal risk, right? And once we've done all of these processes to make sure that you are safeguarded against everything, and this is a safe asset for you with with potential long-term capital growth and very long-term lease revenue, then we'll proceed to contract exchange. Now, but our process doesn't just end there, right? I think a lot of the agents, their processes end at exchange. But even after exchange, right, we provide 2 more things. Firstly, from exchange to settlement, right? If you have any issues, let us know, and we'll be able to resolve for you. We'll be able to communicate with vendor, communicate with the vendor's agent to address for you. We also have a property management team, which actually helps you to find tenants and manage tenancy issues, right? So if you need any help with property management, we also have an in-house team that's very capable with doing that. And I think what makes our Costly Coin difference is our professionalism, our dedication. We work 24/7, right? You call me at 12 o'clock, I'll pick the phone.
Yeah.
Right. And this is, you can explain that. Yeah. We've had many of those conversations before, haven't we? Like you call me at 12, you call even sometimes you call me at 1 o'clock if I'm still awake, right? I will pick up your call. Right. Like I know a lot of agents work on Monday to Saturday. For a lot of us here at Costly Coin, it's from Monday to Sunday, right? This is not an industry where you can get away with doing fixed hours. This is an industry where, like, a deal, whether or not the deal can be done, depends on whether or not you can pick up a phone call as soon as you get it, right? So this is the dedication that we are promising you, and we're promising every single one of our current and past clients.
Great.
Okay.
So what we're going to do now is we're going to jump to question. We'll open up for questions for people here and also online. So yeah, like, do you guys have any questions? Any questions about lending, properties, buyer's agents?
For the examples you give us on the first one,
Yes.
the warehouse one, I have two questions.
Mm.
But first, you write down the land area is 4,199 square
Correct.
meters. How about the warehouse itself?
Yeah.
How big is that?
The warehouse itself was 3,400 square meters. Yeah, across one level and a mezzanine.
What's the interest cover rate?
Sorry, beg your pardon?
Interest cover rate of the loan.
Oh, you mean like the interest rate of the loan?
Interest cover rate.
You mean cap rate?
ICR, yeah.
ICR,
Yeah.
ICR is for warehouses.
I mean, for this case,
Yeah.
that's why I want to know why the bank only gives 50%. I'm quite confused about that because normally I have done a lot of warehouse. I don't think 50% is good. So I want to know the reason.
Correct. Now, that's probably a good question. And look, I like there's more technical things inside the bank that obviously they the bankers at the time would know, but essentially the main issue with this, right, and this is probably a really good question and really good point to point out, is race is occupying an industrial zoned land. So whilst it is an industrial property with very good tenant, race is a retail brand. Now I wouldn't name the bank, but the bank that my client was working with at the time, that bank didn't like retail. They wouldn't give anything more than 50% on retail properties, right? So yes, it is an industrial property, but they classify that as retail because race is a retail client. So this is a warehouse for race, and they have they have their showroom, they have their plumbing fixture all in there, and they classify it as a retail. It's hard to control what the banks think. If you switch banks, they might consider it differently. And this is probably not the first time this has happened. If you look at some other case studies, like especially for instance, like car showrooms, is probably another great example, right? You want to buy a car showroom, it is on an industrial block, it is an industrial property, but because it's a car showroom, they're selling cars. Some banks look at it as if it's a retail asset. And that was probably one of the critical things about that purchase that didn't lead to a very high LVR. But again, if you switch with different brokers, right? And brokers typically have more ways because they work with a variety of financial institutions and super funds, and they might see this differently.
So you still didn't answer my question. What's the interest cover rate? Is around 1.5 or 2.5 or something like that?
That would be something for the bank. I'm not sure I have that.
Because we don't know the rental.
You didn't calculate it yourself before you came to the banker.
It would have been by the bank. It's not our It's
I
not
understand it's not your job, but normally you should understand if they have already tell you the interest rate and you know the yield, so you can calculate it yourself.
When we know the yield, we can calculate the cap rate. So we can calculate, like, in terms of percentage, what's my percentage yield on the rent. But if you're talking about like interest coverage rate, we oftentimes need to consult a banker. And in that case, we didn't even have access to the banker because he was a private wealth customer.
Yeah. So a lot of I would say a lot of customers that sometimes they use a buyer's agent, they all have like their own broker or their own banker. Maybe this client is already a bank client, so he just leave everything to the banker. They don't really necessarily talk to the buyer's agent side, unfortunately. So, and I think for Jackie's case, the client is just happy with 50% then. And because for buyer's agent, it's not their role to really help client to get the finance. As long as the finance is secured, they can, help the client to get the right property. I think, yeah. So.
Okay.
Yes.
Let's have a look at the question online.
Oh yeah. So someone is asking, the case studies were based in New South Wales. Do you also buy in other states?
Yeah. So there was a 7-Eleven. So I guess as a more recent example, there's a 7-Eleven petrol station that we transacted. I remember in June this year. So that 7-Eleven petrol station was also a passive investor asset. In others, so I guess people have different preferences, right? Some people like to invest in New South Wales because it's closer to home. Some people also like to invest nationwide because all they really want is yield. Now, typically speaking, in somewhere like Queensland, you would expect about 0.5% to 1% yield, stronger than New South Wales. But I guess on the other hand, Queensland might not have as strong of a capital growth as what New South Wales would attract. Similarly in Brisbane, Melbourne. Similarly in Melbourne, the cap rates are usually around 0.5% higher on average, compared to a lot of these properties in Sydney. Now, on that particular transaction that we did, it was a $7 million transaction that we negotiated down from $8 million. It was a 7-Eleven petrol station that had 8 years remaining lease term left. And obviously 7-Eleven is it's an international tenant, along with some national tenant in the grocery industry, as well as a fast food store on the premise. In that particular lease as well, I think our client was quite concerned about, if, let's say, in the event where the tenant leaves, what should he do? Because obviously it's a mess to clean up after a petrol station tenant after the tenant leaves. But oftentimes in these leases, petrol station leases, there is a clause which says that upon the tenant leaving, the tenant must clean up after themselves and decommission the whole site, which was something that I guess you've got to have expertise in the industry and having bought service stations to actually understand.
Yeah.
So that's probably a memorable recent transaction that we've done there. We've also bought industrial properties in Victoria before, as well as Upper Brisbane. And also I guess regional New South Wales, so it's not just all Sydney. I guess Sydney is closer to home, that's why we gave as these case studies. But we also bought a Guzman Gomez in West Thamesworth, and we also bought also not just passive investors, but bought a development site for industrial properties down in Bradfield, so near the new airport. And in Victoria there was a owner occupier industrial warehouse that we bought near the airport in Tullamarine. So it's not just New South Wales, also New South Wales, Victoria, and Queensland might be the places where we do the most transactions. Yeah.
Do you want to add something, Tom?
No, I think really good outcomes, and then maybe just the extension of that, Jackie. So investors want to invest, and maybe New South Wales is not the greatest place to invest for its yield or growth. How does Costi Cohen go about educating and advising? Well, if that's a certain requirement or an asset you're looking for, it might be in a different state. And how do you sort of demonstrate that to your clients?
Yeah. So this is really personalized, right? I can't convince a client who wants to look in New South Wales to look elsewhere. Yeah. But we obviously we personalize it for our clients that if they care about yield, right, then we would advise that, okay, maybe New South Wales is not the best place for yield. It's a very competitive market. You've got a lot of A-grade assets in New South Wales that face a lot of competition from all the other buyers, right? We'll advise that, okay, we can look in, for example, Upper Queensland or South Queensland, or we can look at in metropolitan Melbourne. These are sort of places I would recommend. But if the client's looking for more safety of the asset, and the stability of tenants, and also future capital growth, somewhere like Sydney will be where we recommend. Yeah. And also parts of Melbourne. Obviously, right now, as you probably know, Melbourne doesn't have the best investment appetite in the area. But yeah, depending on what the client's looking for, we'll give these corresponding advisors. But ultimately, we would like to follow what the client's looking for, and then on that basis, we give the additional advices on where they should be looking at. Yeah.
So we got a question here. What are the rental yields for the warehouse and the childcare?
Yeah, so for the for that raised property, the rental yield was 4.6%. Now, for now you might think that this is not a very high yield, right? But if you think about it, there are banks, like for example, like the Commonwealth banks, the Westpacs, that's been transacting at 2.3%, 2.5%, 3%, you know, and that's incredibly low yield. And why is it so low? It's because people are all fighting for it. They all want these properties. These tenants are going to stay there for a long time, just like Race. Race has been staying in their property for the last 15 years. They're not going anywhere. They will keep on going into the future. For these assets, it's very, very competitive. And to get above 4.5%, it's pretty impressive, at least for Sydney. For the childcare, on the asking of $12 million, it was roughly a 3.9% yield, which is obviously very low for childcare. But on the basis of like after our negotiation, we were able to negotiate down to $9.6 million. On that basis, we were able to get a 4.8% yield. Yeah, on the childcare. The childcare average yield in Sydney is also around the 4.5% mark, getting to anywhere in the upper 4.5 something percent, or close to 5%. Again, that's pretty good as well. Unless obviously if you go to very very regional New South Wales, or like a recent example might be in Picton in New South Wales, the Leaping Learners Childcare that recently got a 5.13% yield, but we're talking about 5 Dock, right? And 5 Dock is probably the upper end of town, a very big land mass. So it was so that 4.8% in 5 Dock was a fairly good price as well. Yeah.
So someone is asking, what is the minimum purchase price for a good commercial asset?
That's a very broad question. Look, it depends on a couple of factors, right? You firstly need to know where are you buying, right? Obviously, different whether you're buying capital cities, metropolitan, or regional, that will make a huge difference, right? Are you buying strata or are you buying freehold, right? That's also a huge difference, right? Because a strata warehouse and a freehold warehouse, they are very, very different in size and scale, and also your title. I think, look, at Costicon, we've got a department specifically for under $3 million. We've even transacted on properties that are like $800,000, $900,000 before, So I think, yes, very hard to say.
Yeah, circumstantial. And I think it's okay to say that, like, like, unless you're willing to invest north of 1.5 to 2 minimum, like, that's where you start to see, the relationship with the quality of the asset increase. Now, there is definitely opportunities that you can get. And there's often a fee for service to acquire that type of asset, but they're few and far between. And then you start exploring different risk, like, asset class, or interest rates, metropolitan versus regional. There's a whole lot of factors, but I think it's okay to say, like, north of 1.5 is sort of where you want to be starting.
We would give different advices on these budgets according to what the client is looking for. I think it would be irresponsible for me to set a particular benchmark.
And everyone's got a very different risk profile. Someone who's maybe looking, thinking about retiring at a certain point, who's got a lot of cash in their SMSF, looking to invest.
And whether or not you want to use leverage.
That's right. Yeah, exactly.
Is there a data source which shows the capital growth or past performance?
Look, we oftentimes like to use your popular softwares, and maybe Tom, you can chip in on this as well. Like we use data sources from for example, like CBRE, JLL, like these big commercial agency firms. They publish their industry reports, and they've got data analyst teams that produce these figures. So we would oftentimes read through these. Also, using CoreLogic as well as using commercialrealestate.com to monitor the market. Some of these reports will tell you, like, in this, for example, in one of the recent JLL reports, right? And there was also another Stonebridge childcare report that I've been reading. They actually tell you, like, compared to 2022, now it's 2024. So over these 2 years, how much has, on average, has childcares and industrial properties been growing? But more often than not, I actually go through these data on CoreLogic and commercialrealestate.com for a similar geographical market to assess how much it's grown, right? Based on the median values of these transactions. Yeah.
The other point I'd make, and it goes back to the slide that Justin showed before around who's typically funding these type of investments. So there's a big shift in the non-bank or alternative funding space, and that those private lenders have got a keen eye on the commercial space, and they often will promote and project their own views on where they're investing, why they're investing, and why that's attractive for wholesale investors. So another different source just to complement some of the things Janie's talking about.
Which asset types are more favorable in this current market?
Sorry, what type of assets more favorable
in this current market?
in this current market?
And also price range.
Yes, another broad question. Look, because obviously today's masterclass, and there'll be a lot of masterclass afterwards that covers a variety of more different kind of topics. But today we are more about passive investing. So if we are just talking about passive investment, for the division that I head, which is Asia market, the reason why I gave a warehouse and childcare example is because a lot of the Asian customers like to look for warehouse and childcare type of assets. Now, there's also, don't get me wrong, there's also a lot of clients that like to look for retail as well. Personally, obviously depending on the region, I don't like recommending retail because there's a very high tenant turnover, right? Tenant comes, tenant leaves, right? A lot of times my client like to look for stable tenants. So why childcare? Childcares usually have a 10 years minimum initial term. So with the current childcare operator, they will be in there for at least usually at least 10 years, right? Before deciding whether or not they're gonna continue to stay on. And even after these 10 years, you've typically got 2 times 10 years option. What that means is the childcare operator is willing to stay for another 10 years twice. So that makes 30 years overall. Now sometimes some childcares can also have a 15 years initial term, or even we've even seen like 20 years initial term before. So for a lot of the clients who are looking to just buy an asset, leave it there, and just collect rental income, right? Childcare is probably a really good choice for them. But obviously, this is you've also got to be very careful, because when we go through these childcare properties, there might be a lot that looks really good on surface, meets all the criteria that we're talking about, but you actually don't know what's happened there or what's happening to the tenant right now, and that's a part of the due diligence that we've got to do. The other thing that I would recommend is obviously industrial space. The main reason for industrial is the capital gain, right? Ever since COVID has happened, from COVID to now, you're seeing a huge capital gain in the industrial space. Industrial space became really popular in 2021, especially following like the emergence of the online shopping, rising construction activities, requirements for storage space has significantly increased. But from 2021 to 2022, there has been a slight decrease in people's demand for industrial space. And in 2022, 2023, I think the proportion was still the passion for buying industrial was still not as strong as back in 2021, 2022. But like in 2023 to 2024 financial year, the passion for buying, people interested in buying industrial space has just emerged again. It's boosted again. So and again, other than the capital growth, it's the ease of tenancy. It's easy to find a tenant. Depending on where you are, it's a very broad term. And oftentimes, I guess, compared to retail, industrial properties also have a longer lease term.
Mm.
Why? Because you think about it, if a tenant was to occupy an industrial space, they need to move their plants, move their equipment into the space. And it's not so easy for them to call quits and say, I'm not going to continue with the tenancy next year, especially if they're performing well. Yeah.
So I think
question.
Yeah.
So in terms of the asset type, you mentioned most of your clients want to passively invest to the commercial property. So for them, probably childcare center, warehouse is more safer for them to invest and look after. But what if they want to put some effort on the commercial property, say like a small shopping center? Would you recommend this type of assets? Especially if the shopping center has anchor tenants like the Walmart.
Yeah.
So would you still recommend to invest those kind of assets?
That's a really good question. Now, there's a couple of factors you've got to assess. So something that you've said really correctly is the fact that you've got to be a bit more hands-on. You've got to do more work. But the upside to it, or the upside to managing multiple tenants in a particular property, is that you oftentimes attract higher yield, right? I guess in the cases that I was talking about, it's mostly single tenant, right? But in a more complicated case, like you said, in shopping centers where you manage multiple tenants, you oftentimes can get yields of up to 6%, 6.5%, or even 7% in some cases, right? So there's definitely good rental yield upside to it. Would I recommend it? Depending on the location and depending on how the shopping center is performing. When you have multi-tenanted properties, your due diligence process becomes even more important and more complicated because you've got a lot of leases to review. And I guess in the case of a shopping center, it's similar to retail in that also you have so many tenants. Their leases all end at different times. Typically also short-term leases, just like any normal ordinary retail. But I guess as long as the shopping center is performing well and that the tenants in the shopping center are making sufficient money, sure, they'll stay on for long term. But a lot of effort. If I give you an example, one of my clients, he didn't buy a shopping center. He bought an office building that had 6 tenants in it. Now, 6 tenants, you might feel like, that's actually not a lot. But when you have 6 tenants all having each different issues, at the end of their tenancy period, needed to negotiate with them, etc., you start to feel like it's a lot of work. Yeah, and a lot of my clients who bought single tenanted assets with me had a similar concern. They just didn't want to spend that time and effort in actually managing these tenants. But if this is probably like one of the only few things that you do and you have time for it, I 100% encourage it. Yeah.
Yeah, because what I've heard from a lot of people say that they bought the shopping center, the banks really like the shopping center. And over the 3-5 years period, the variation of the shopping center was a significant increase. Yeah. So compared with a warehouse, it is good capital growth. But compared with shopping center, I think it's different level. I think shopping center variation is much better than the warehouse.
I think Jocelyn, you can speak to it as well. But banks do like multi-tenanted assets because it decreases their risk, right? If it's a childcare or like an industrial warehouse, like the ones that I've been saying before, sure, it's listed tenants, right? Very big tenants. But in the case where they leave, then that presents a very big risk for the banks, yeah. Because oftentimes, like one of the things that you can do in commercial property that you can't do in residential is to use a lease doc, right? So lease doc loan. Now, lease doc loan primarily focus on the quality and the nature of your lease. Yeah. So if your existing tenant's gone, well then, banks face a lot of financial risk. When it's multi-tenanted, then at least if one of the tenants gone, there's still a lot of other tenants that are there to continue the revenue going. Yeah, so they like it. Exactly how it works, maybe.
Especially something that has anchor tenants like Woolies, Aldi.
Yeah.
Banks really like those kind of shopping centers. So
can I just say though, if the premise is only anchored by Coles or Woolies, banks might not have as strong an appetite for it. But yeah, if you have like big shop, big brands like Coles or Woolies anchoring the property along with some minor shops, then yeah.
But remember, the LVR for the two properties are totally different. So it really depends on your customer's financial. If they got enough money, definitely buy shopping center. But if not, it's different. Because LVR is much smaller than the shopping center.
Yeah. I think to close this, I think perfect way to close this is a lot of people are asking what is the buyer's agent's fee structure, the ballpark of your professional fee.
Yeah.
But I think this is something that maybe we can,
discuss more.
Discuss more privately, and we can share these details. And to finish up, let me just. Yeah, so if you again, I just want to thank you everyone for joining us today. Thank you so much, Tom and Jackie, for sharing your invaluable knowledge and insights today. So we hope that today's session inspire you to take the next step in your commercial property journey. If you have any questions in regards to lending, or you want to contact details of Tom and Jackie, feel free to scan me, add me on my WhatsApp, and then we can go from there. And thank you so much, everyone. We hope to see you at the next commercial masterclass. Thank you.
I love questions from the online audience.